All right, just coming up for 7 past the hour. We're going to get cracking in just a moment. Hopefully you enjoyed that. Hopefully you got some, maybe you identified some new gaps or some other gaps that you didn't quite take into consideration before. But these are the things that you're going to need to build and put all this together as a trader. We're not really going over anything that isn't vitally important. We don't add fluff or showmanship into any of this. It's very much directional to get you from A to B as efficiently as possible, using the most effective methods. So that's the key. What we're going to do now, based on everything I've just said, is literally go through a strategy, and we're going to go through the identify phase, the prediction phase, the decide phase, and then we're going to be talking about the execute phase. But before we do that, I just want to reinforce that you can make any strategy work, pretty much. And what I mean by that is, who's seen the emergence program that we did? The very first emergence program when we launched Tier 1. And I started making something up on the spot, and I said, let's just sell or buy every time the RSI goes oversold. And what we'll do is when it goes oversold, we will buy next bar market, and then we'll trail the stops up, or we'll do a 1-to-1 or a 2-to-1, I think it was. Sometimes it was a 3-to-1. And it was working out. And now I didn't take that strategy and do anything with it. In fact, Anthony Reno, he took the liberty of going away and of course he did, right? Building this automation that would figure out and go and test it all. And I think he found it to be profitable, but there are ways that you could tweak that to make it very profitable with qualitative analysis, quantitative analysis, adding filters, and making it your own and making it work. Because let me just say, if you was to wake up every day and you had consistency and you just bought the euro dollar at 7 a.m. every day, and at 8 a.m. every day, you sold it back. If you did that for an entire year, you are going to have one of 3 results. You're going to be consistently winning money, you're going to be consistently losing money, or you're going to be at break even where you started. They're the only 3 results you can possibly get. Now that's as simple as it can be. Okay? Now, on top of that, you've then got the ability to go and say, well, if it's not profitable, why isn't it profitable? Because all you're doing is buying and selling. Why wouldn't that be profitable? That's all trading is. So hidden amongst that approach and that strategy are little clues that you can change and tweak and adapt to make it profitable. And there's no other secret than that. So the only way you're going to be profitable is to take a strategy and develop it to suit you and your personality and your lifestyle and make it your own so that you know the ins and outs of it and you're really connected to it. And then once you've gone and tested it and you know all the numbers and the expectancy, then you've got the mindset and the psychological strength to actually go and trade that live. And you know, in your heart of hearts, you've got the confidence that you know what's likely to happen. And that's the absolute best position that any trader could be in. Okay? Good stuff. No fluff, just essential information and education. You know our style, Neil. So let's go through the identity phase. Now you might want to, I don't know if Darren managed to find the trade plan. We'll send out the trade plan template. You might want to scribble this down as we go. All right, and I'm sure you're going to have many questions. The identity phase is to identify what direction the trend is in, whether it's a bullish trend or a bearish trend. Okay, now we know that 3-point move, we know if it's moving up, it's bullish. If we move it down, it's bearish. We also know that the cycles, if we're looking for a trend trade, we're normally looking for a pullback of some kind. Okay, we're looking for a phase 2 or a an outside return or a pullback or a retracement or whatever you want to call it of some type in that direction. And that way we know that if we get that pullback, we're likely to then reverse and carry on to the upside, okay? So we know that markets move in cycles, and we know that bullish is up, bearish is down. Very, very simple. You guys should definitely know that. If you don't, you do now. He did send the link. Awesome. We also know that markets respect structure, as Akil just went over. We know that we get a respect of structure. We know that markets are likely to pull down to certain levels if they're to continue up, or if they're in an upward direction, we know where they're likely to go next before we see a reaction. Fair to say? And you can go out, and we'll look at some examples of this, but you can go out and put horizontal lines on your charts, and you will see time and time again these levels are tested and touched and respected. And that's just the way it is. Now, why do they do that? And why is human evolution that way? We don't really care. We don't really care. We just know that it is. And we know that if human evolution and human psychology is predictable and it's represented by graphs, and we can take note of those reactions and make predictions based on those reactions, do we really care why humans are the way they are? Not really. We just know that we can make money if we can build rules, specific rules, around that. Right? Good stuff. Okay. So we want to do the identify. We want to be able to identify the phase of the market. The next thing is to predict. Now, what we're going to use for predictions is, obviously, if we're going in a certain direction, what we're using for predictions is, as long as we're not at major structure resistance levels, we're likely to continue up. If we're not at major support levels, we're likely to continue down. And the prediction is the market's likely to continue in that direction unless it shows signs of a reversal, like a double top or a head and shoulders or some kind of reversal where the market's no longer in a strong trend. And that's something you'll need to refine and build and understand. Now, something that we can help with a prediction here is a strengthening in trend using what I use here for this particular system, which is exponential moving averages. And why do we use exponential moving averages? Because they react a little bit faster. They're a lagging indicator anyway. So using one moving average is not wise. Using one exponential moving average isn't really wise, which is why I use 3. Because if you can get patterns in a 3, that gives it strength, that gives it power, that gives it confirmation, it adds to the prediction. So what we're looking for is the 20 and the 8 and the 50, or the 8, 20, 50 EMAs all fanning out, okay? And they start to fan out and one's on top of the other. So the 8 is closest to price in a bearish trend, the 20 is the next closest, and the 50 is the next closest. And if we're in a bullish trend, it's the other way around. We have have I got a bullish prediction here? There we go. So in a bullish trend, we have the 8, the 20, the 50, and in a bearish trend, we have the 8, the 20, 50, but it's from price action. Okay, so in a bullish, the 8 will be nearest price, 50 will be furthest away. In a bearish, the 8 will be nearest price, 50 will be furthest away. Okay, you guys that are in tier 1, you'll be very, very familiar with this system. Okay, so if they're fanning out, we know that there's likely to be a continuation in trend. Because as they get further and further away from each other, they're approximating a wider moving average overall, which indicates that the trend is building momentum and is strengthening. Okay, now if they start to cross, like at the top right-hand corner of this image, then there's some murky water. This is where we build our discretion into our prediction and go, not likely to carry on there because we're crossing over. You know, there's a slowing down in the trend, even though it is a lagging indicator. All right, would that be with a daily, hourly? This is all the daily time frame. Okay, I'm not actually getting into the strategy just yet, but We're going to start doing that now. Okay. So the next thing is the decide. Now for the decide part, we're looking at specific candlesticks and what we call the doji. Now I don't want you to look at these two on the left. What I want you to look at is the one on the right, which is a pin bar, okay, or a hammer like this. Or you could use tweezer tops because in certain scenarios, you get one opportunity and then that one becomes invalidated and the second tweezer top is still a valid opportunity. So we're going to look at those as well. But ultimately, it's the daily candles and the open. You have to write this down, okay? You definitely have to write this down. Ready? It doesn't matter if they're a red candle or a green candle, bullish candle, bearish candle, in either direction. Okay? But the open and the close, I recommend to look at within the lower 30% of the entire candle body. Okay? So the open and the close needs to be in the lower 30% of the body, and that is in a, remember, that's in a bearish trend. Okay? And in a bullish trend, the open and the close of the candle need to be in the upper 30% of the entire body. So you can see very clearly here, this band up here is the upper 30%. We've got the entire candle body, and that is open and closes in the upper 30%. If you want to know how to work that out, because some of you might not use the 30%, some of you might use the 50, some of you might use 10, okay? Remember, I'm teaching you some rules so that then you can go and test them. Now, the way that you might quickly work this out is by using a fib on the candle, as Sarah just said. You can use fibs, you can set a 30% or 33% or 50% or whatever you want and put it on your fib retracement, and then you can measure it out. Really quick and easy way of doing that. All right. Now, the decide part is seeing the opportunities and where we can actually get involved. And the pullback means a pullback to the 8 moving average. All right. So the 8 moving average we must either touch or be below in a bullish trend, or we must touch and be above in a bearish trend. But we have to touch the 8 EMA, and that candle signal has to represent itself or present itself at the 8 EMA. Okay, so in a bearish trend or a bullish trend, it's going to look like this. Something like this. And as I say, it doesn't matter if it's a red candle or a green candle. It just has to have those rules: open and close in the upper 30 or open and close in the lower 30 if we're in bearish. Everyone following so far? Everyone's following so far. Great stuff. Great. Any questions so far? We normally get quite a few questions at this point. And people normally say, yeah, but does it work on the hourly? Does it work on the 4 hour? Does it work on the half hour? And we start going down that rabbit hole. And I'm like, look, this is a daily strategy. If you want to go and test something like this, I'm glad it's opened your mind to do that, to the possibilities that a trading strategy is something you can develop and it's not something that Pip Daddy's selling online. I've won at that, but like I've for me, that is amazing that you've even opened your mind to that possibility. Engage, you must wait to the end of the day. Yes. Okay, because this is the daily signal, you need to wait till the end of the day until the candle's fully formed. Otherwise, what? What might happen if you don't wait to the end of the day? Might become invalid. Yeah. And then you've taken, and then you're in a trade that you don't know the results for, right? You don't know the possible outcome. So we need to wait for that. Okay? Okay, so everyone with me. Now, the specific rules for deciding to execute is the signal needs to be in a bearish trend. It needs to touch or be above the 8 EMA, and in a bullish trend, it needs to touch or be below. Okay, so there's some examples right there. Now, out of these, there's going to be some that aren't valid. Okay, so these two here aren't valid because if we're looking at getting short, this one here hasn't touched the EMA. And if we're looking at getting long, this one hasn't touched the EMA. Does everyone make sense? Does that make sense? Great. You guys are a good group. Smart group. The amount of questions I've had on this before. Good stuff. And then we execute. Okay, now how do we execute? How do we execute the trade? Because we know we've got the candle body. We know we've predicted, we've identified the cycle. We know what direction we're going in, how we're likely to get there. We've made a prediction based on some qualitative indicators as well. We've decided how we can get involved using candlesticks, and we know the rules of the candlesticks. We know where that needs to touch and how it needs to form and when we can't get involved because it's not valid. So now we just want to execute the trade because we've got a valid setup. Can we easily find an EMA indicator? Yes, and I'll show you exactly how to do that in just a moment. So we then go out and we look at some examples of the markets, and this isn't the examples I'm going to go to live, don't worry, this is a screenshot. I'm going to go out live into the recent markets as well. But we can see right here that we are in a bullish or bearish trend. What's the identification here? Great. And what's the prediction in hindsight? Obviously, you can see the whole move. Bearish, right? It's going to continue. But what else plays into the prediction based on what I've just taught you? Not just the fact that you can see the whole move. What plays into prediction? Yeah, the EMAs fanning out. They're all in the right order. All the ducks are in a row, okay? Now, there's a few opportunities here that you might not have seen. But everything I've just explained is right here multiple times. This is why it's so crucial that you know your strategy inside out, because there's no way that most of you would have seen that many opportunities there. You would have gone, oh, right, okay, he's going to show us one opportunity. Bang. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 opportunities. And there's even more on there, but the reason I haven't indicated those is because we would have been in previous trades. All right, so you wouldn't have been able to be in that trade because we'd be in previous trades. So there's lots of opportunity there. Now, how do we actually get involved? How do we actually get involved? So let's just say that we get a pullback here back to the 8 EMA. So we're going to use this indicator here, this signal here up the top left where it says sell stop. So this green candle, this is the first one we're going to do. Even though there was one before, I could have done that, but we didn't have enough room there. So you can see there was two in a row here. But as soon as we get that indicator and the open and the close is in the lower third or lower 30%, whatever it is that you choose, and we hit the 8 EMA, and the 8's below the 20 and the 20 below the 50, and we're in a bearish trend, and we made the prediction, and we're deciding how to get involved by identifying the candlestick formation that we need, we're now ready to execute. Soon as that signal has been made, which means next bar has started, the next day candle has started, we want to place a sell stop order below the low. Now, where below the low is going to be discretionary to you, 2 pips, 5 pips. Some people like to allow for spread. Some people use ATR. Some people just use a fixed this many pips, Okay, and it's not for me to tell you exactly how many pips to do that by. Because what I want to get out of this is you to go away with the abundance of opportunity in your mind and the excitement of becoming a developer yourself. Because that's the only way you're going to be profitable full time, long term. All right. So we're going to set a sell stop order. And a sell stop order is an order below the current market price, telling your broker that if the price drops to that level, you want to sell at a certain price. Okay. So that's what we're going to do. So when you place that order, it doesn't mean that you're in a trade. It just means that you've told your broker that if we drop to that level, I want to get in. Now, why do we do that? We do that for extra confirmation. We do that for if the next bar market opens and we start to drop, there's your extra confirmation. If we start hovering around and start putting in doji candles, indecision, then it's going to weaken the opportunity and we don't want to be involved. We want to stay out. So this is a way of setting an order that allows us for extra confirmation to tell the broker that I want to sell if we drop below this point here, because this signal is a strong signal based on my prediction and my identification of the market and what's likely to happen, that we're likely to carry on down. Okay, so we set a sell stop order. That's our entry order, guys. Okay, entry order. Once we've set the entry order, we want to place a stop loss. And I want to always refer to order placement as entry stops targets. Entry stops targets. And if you just refer to them that way, even Darren, who produced some documentation for the direction of today's session, he wrote entry stops targets, entry stops targets. We have built that habit of referring to orders that way because why? Because when you're in, the first thing you want to do is protect yourself. First thing you want to do is protect yourself. You want to think about not losing money before you think about winning money. And if you can get into the habit of referring it to that way, you'll always set orders that way, which is a great thing, great habit to get into. So the next thing we want to set after the entry order is the stop loss. Now this is going to be a buy stop order, because it's exactly the same as the sell stop order, but it acts as a stop loss. It's telling the broker that if price pushes up, once I'm in the trade, if price pushes up to a certain price that's above the current trading price, I want to buy my position back at a loss. Yeah, and bear in mind that you can only check this once a day. So in real time, this might look a bit overwhelming, but in real time, this is like a 5-minute job. If that, on one market. Okay, so again, once we're triggered into the trade, we want to place a stop loss to cover the position, and that's gonna be the same as the rules for where you placed your order. So it could be a 2 pip stop, it could be a 5 pip above the high, it could be an ATR above the high, whatever it might be, but you want to go roughly 2 to 5 pips above the high for a starting point, 2 to 5 pips above the high of the candle, the signal candle. So the higher the spike in the candle, the more of a pain, because the bigger your risk is, potentially, if you're not trading a percentage-based risk. Okay, but then you're in, you've got your stop loss on. So once we've got a stop loss, all that's left to do is set a target order, right? Now, there's no rules for where you want to stop put a target order. You could actually, in fact, this has got the wrong name. Look at that, how ironic. This should be a buy limit order, guys. God, gonna change that right now. Had to happen, didn't it? Had to happen. Buy limit order. Giving it some whiz kid on the old keynote right now. Look at that. Look at him move. Okay, Okay, mad skills. They just call me Bob Ross of Keynote. So, back to it. This is based on a one-to-one reward to risk. Okay, so you like that, Bob Ross? Look at these crimson red candles. So we've got a one-to-one reward to risk, and and that is a rule where you say, okay, I've got whatever the distance is between my entry and my stop, I'm going to have an equal distance between my entry and my target. Make sense? Very simple. Now, some of you guys might split your position and take 2 targets on this. Some of you might shoot for a 2-to-1. Obviously, that's going to completely depend on the system you want to develop. If you're shooting for a 2-to-1, you're going to have less. You're going to be wrong less than you're right, more than you're right. Okay? If you're shooting for a 1-to-1, you're going to be right more than you're wrong, but you're going to have less reward to risk. Make sense? See how it's all coming together now? So you want to bear that in mind and how that suits you. If you're shooting for the moon every time, the chances are you're not going to get as many opportunities either. Okay? So there's something to bear in mind. Now, the order in a bearish trend would be a buy limit order, as I've quite rightly changed here, a buy limit, which means that if we're in the trade, I want to buy back at this position here. So you can see in this instance, this one was profitable. Okay, now there's many, many more here, and I want you guys to have a little practice on this as well. You can go in, you can identify these on the daily, go through what I just explained, see where your entry would be, then your stop loss would be, and remember, you're only placing your stop loss and you're only in the trade once the next candle is pushed into your sell stop order in a bearish trend. In a bullish trend, it's completely opposite. All right, it's the other way around. But you can see, you would have got in here and hit targets. You would have got in here and lost. You wouldn't have got in here because you didn't get triggered. Okay? You would have got in here and potentially hit targets. You would have got in here and hit targets. You would have got in here and not been triggered in. You would have got in here and hit targets. So out of all of these opportunities, there's probably 4 or 5 winners and a couple of losers. 3 losers. So again, going back to the strike rate, you're right 60% of the time, maybe 60, 70% of the time. And that's a great starting point. Great starting point. Any questions on that? And by the way, if the trade hasn't been triggered in the next day's candle, the trade is closed off. Okay, so then you look for the next one. And you might get one candle form that's a valid signal, but because the next day candle doesn't trigger, you have to take that trade off, but the next candle could be valid as well, which is why I mentioned tweezer tops. Because right here, you could have this situation. In fact, this would be a very powerful situation. This might be some qualitative analysis that you add. And depending on if you get tweezer tops in a bearish trend, you might say, I'm going to go for 2 targets when I get tweezer tops. Make sense? But no other time. I want your imagination to start emptying ideas and thoughts onto a piece of paper now. If I get tweezer tops, I could double my position size, or I could increase my risk, or I could take multiple targets, or I could be tighter with a stop loss, or I could be, I could be tighter with the entry. Make sense? All of these little things will add up to a better edge, a better trading system for you. And I want you to think that way. I want you to get into that way of thinking. Qualitative analysis. This is why I say understanding the basics, understanding how the market moves is going to add power to your punch as a trader. All right. And as Darren says, starting with the information, adding the discovery phase. Yeah. So you take what I've said and then make it yours. And try and get something that's profitable. And I tell you what, when you take some ideas and a system that's already got edge and you make it profitable for yourself, you're unstoppable as a trader. That should be the goal of every trader. Take a system, make it profitable. Because then it's like, no matter what happens, you know that you can always make money. Because you know the ins and outs of what's going on. And you know, if something's not performing quite as it was, you know what you've got to do to change it without starting from square one or trying to find another system that works for a little while. All right, so let's take a little look, shall we? Let's take a little look at some real live markets. So I've just bought on TradingView, and by the way, I haven't done any pre-checks here, which I probably should have done because it saves time, but I haven't done any pre-market checks. But I do know that there was a couple of daily chores recently on these pairs here, Aussie dollar and pound dollar, and I just know that because, well, I do. Akira says that's the safety in being able to control your finances. Yeah, absolutely. Great stuff. All right, so look, we could start with either of these, I guess. What should we start with? Should we start with the... I'd like to show you an opportunity in both directions, really, but we've been very bearish lately, so let's just start here. So you can see this is the Aussie dollar on the daily. Now look at this. For starters, what I'm going to do is I'm going to say, what is the identification phase right here, guys? You let me know. What's the identification phase right here? There. Okay. Prediction is we're likely to continue down. Now, what plays into the prediction that I mentioned in my little rundown of this strategy there, that we're likely to continue down? EMAs. Right. Fanning out of the EMAs. We've got the power of the confluence of all three, which means we're approximating a wider EMA across the board, meaning that we're strengthening in trend. Okay. Now, what other qualitative analysis have we got here? We just so happened to be at major structure support. Major structure support following this big old kind of head and shoulders setup that went on here over a long period of time. And we broke through that neckline, and guess what support normally becomes? What does support normally become? Resistance. Okay, so now we're in this pullback phase. We're in this pullback phase. And the pullback phase looks like this. All right, so we're in the pullback phase. And right here, we start to pull back to the 8 EMA. Now I'm going to zoom in right in here. Now we've got qualitative analysis here, and we've also got quantitative analysis based on the number of touches. So it's a high quality level of structure. We just know that because it's a level of structure that's respected time and time again. And the number of touches can become your quantitative analysis, which again, that might have a deciding factor on how you trade this daily signal. If you've touched that level of structure 3 times, you might trade it a certain way. If you've touched it 5, 10 times, you might trade it a certain way. More opportunities, more possibilities, more rules to add, more filters to add. Okay? Now, it just so happened in this situation, we had a real nice level of structure. As we approach that level, we put in a signal that looked like a valid signal. You tell me, was this valid? Was this a valid signal? Yeah. Why is it valid? You tell me. Why is it valid? And if you guys are watching in the recordings here, you can just shout at the screen. On the 8 EMA, yep, lower 30%, correct. And again, you can measure that out. If you could bring on a 30% on your fib retracement tool, you can have it on your tool And you can see that it's below the 30%. It'd actually be 0.33, but we're below 0.3, so that's even less. Okay. Oh, by the way, to get the EMA, you just go up to indicators, type in EMA, and there it is. Moving exponential average. You can just click that. It will add it to your charts. See, it's just added another one here. And then you double click on here, and then you set the inputs on each one. And I would advise changing the color of each just for ease of, so at a glance, it's much more visually appealing and easy to see. So this is a valid signal. So what we do is we come in and we say, right, this candle closes. If this candle closes in the lower 30% and the open and the close are in the lower 30%, I'm going to set a what order? What order do we need to set? I appreciate this is all in hindsight because we can't actually do one of these now because we've still got, 4, 5, 6, 7, 8, 9, 10. We've got 7 hours until the end of the day or into the close of the session, or 6 hours and 15 minutes. So there's not going to be anything setting up right now that we can actually show you live, but this is as live as it gets. So a sell stop order, yes, correct. Now, next time, the next thing happens is the market pushes in. And we get that extra confirmation. This just happens to be a 3-bar reversal as well, which is another candlestick formation, which might add rules to how you trade this setup. See where we're going with this? The possibilities is what you should be excited about, and building those possibilities into a system. 3-bar reversal, great. So, soon as we're in, we want to tell the broker what? I want to cover myself. I want a stop loss order, which is a what type of stop? Buy stop, correct? And let's just say that this is we've worked out the position size based on a 1% of our account. Okay, so 1% risk on the table. I'm going to color this red and we're in. All right. Now, very simply, we know where our target needs to be, don't we? Because if we're going 1-to-1, we just want to copy this measured move here, and we want to say, great, I want to take the 1-to-1. This is going to be my target. I'm going to set another order here to my broker, and I'm going to tell him I want what type of order? Buy limit, yep. Even though my slides were wrong. I'm sure people will remind me about that. And then you're in. Okay, now this is a 1% trade. You got the 1% trade that played out in our favor. Now, look, based on the fact that we were at major structure and we had a 3-bar reversal, some of you are also looking at exhaustion, and that's a whole nother topic which we can get into another time. But you can see that market's running out of steam here. You see that? Got the big bullish candle, bullish, and then it runs out of steam. And we have the 3-bar reversal. If you have that scenario, you could say, if we ever have that scenario, I'm going to take targets off here, but I'm splitting my position for retest of the lows. Yeah? So you might take secondary targets down here. And this is where you really start to earn the money. If you can match the two and use your edge and properly, an understanding of the market. This is why I said that was important. Because it's going to give you more opportunities in developing your system and your strategy and your edge overall. Now you might even trail stops. You might even keep going until you get stopped out. You might trail stops. I'm not going to go into trailing today, but there's an example there. All right. Now, have we got let's see if we've got let's see if we've got another opportunity. I think there was one on the pound Aussie or the pound yen in the other direction. Okay. Right. So, by the way, you can see my predictions here. You can trade the trade. You can change the trade while in the trade. Yeah, depending on what price is doing or what other signals. You have to be able to be adaptive as well. You know, there's definitely opportunities to make more money if you're able to adapt. But again, if you're going to adapt whilst you're in a trade, you have to have bulletproof rules so that you're not changing those rules each and every time you place the trade. Now, are we in a bullish or bearish trend at this point? First of all, let me test you. Would we be looking for this setup here? No. Why wouldn't we be looking for the setup here? Sorry, here. Choppy, too close EMAs. The EMAs aren't in the right order for a start. They're crossing over. Okay, very specific. If you say things like they're too close together, how close is too close? You have to have, it has to be specific. Can't be half pregnant, I always say. Can't be half pregnant. Your rules need to be like board game instructions when everyone's arguing about Monopoly at Christmas and you bring out the rules and go, no, it says there that you can't owe me money anymore. You've lost. That's how your trade plan wants to be. You want to be able to give it to someone and they understand it who don't even know the first thing about trading. So at this point here, we're in a bullish trend and the moving averages are fanning out, which is great. We've got a prediction that we're likely to push up higher. We decide how to get involved by identifying a specific candle signal and a specific pullback to the 8 EMA. Now this one we've seen right here. I don't know if you guys can see it. Boom. We're hovering on that 8 EMA. We touched the EMA, we pushed down and we opened and closed in the upper 30% of the candle body. Okay, soon as this happens, what do? We tell the broker that we want to place a what order above the high of this. See if you guys are listening now, because this is the opposite direction. A buy stop order, yes. A buy stop order. So the buy stop order in this case goes wherever you're putting it above the high. Okay, say 2, 5 pips, whatever it might be. And we know our stop loss, once we're in, once the market pushes up, and you can see the next day, this is a bit painful. Why is this one painful, guys? Why is this one more painful than the last one? Because remember, these are the daily candles. One, it's a longer tail, so larger risk. But if you're risking 1%, it doesn't really matter. It just means you might, you'll be in the trade a little bit longer. But more importantly, remember this is the daily candle. So every one of these represents a day, which means the next day you was triggered into the trade, but God, it just moves sideways. And that in real time, when I say get real and talk about and be poised and neutral and realistic about what the future looks like, if you can preempt that and think, how will that look in real time? I'm actually going to be sitting there in a trade for a whole day, the next day, and it still hasn't hit targets. And potentially the next day didn't hit targets, or the next day, or the next day. Which is why it's so crucial to test. Because if you've tested it, you can say, well, I haven't got FOMO because you know what? On average, I'm in this trade for 5 days. What does that do? It calms your mind. And guess what? You could go, every time there's a 3-bar reversal or major structure and I take the trade, I'm in the trade for 1 day or 2 days. And that calms your mind. Every time we start to be a little bit more choppy, I'm in it for longer. So get real. As much of that as you can put into your analysis and thought process and have documents there stating those things, the stronger you're going to be as a trader. So look, we've got our entry in, we've got our stop loss in, we've covered our back. Now we just want to get out at 1-to-1. Okay, so we're getting out. We're telling the broker to place what type of order here? This will be a tricky one. Sell limit, correct? Well done. This is a great group, by the way. I have to say, Akil, Darren, Charles, like, I don't know if you've... This is a great group. Like, really good quality questions, great answers, like, really good. And you can see, we ran away there. So, we're out of the trade. One thing to bear in mind is as we're in this setup here, we can't take another trade. So there might be other opportunities that play out like this one. Let's just say, for instance, you were shooting for a 2-to-1, okay? If you start documenting, oh yeah, well, when I done my testing, I had another opportunity here. Well, you're not going to be in this trade, are you? You won't be able to take this trade because you won't be out of this one until here, 27th of July. And it's really important that you understand that, because then you're going to lower your expectations of the system in your testing, which is, God, I can't emphasize how important that is, to lower your expectations. If you increase and heighten your expectations, you create a fantasy which puts you in depression when you can't actually perform at that fantasy. So if anything, you want worse results in your backtesting. Because when you're out there trading live money, you want to feel like you're performing at least how you expected. At least. Can't stress that enough. Can't stress that enough. The moment that creeps in and you start thinking that you're underperforming or something's wrong with your system, yeah, it's a tragedy. Because there's no need for that. It's hard enough without all that. So everyone's happy with this. Now, one thing I want to show you is if you guys are... We're going to do a giveaway today. We're going to do a giveaway. We did a giveaway yesterday. We're just doing giveaways nowadays. You can see that in Tier 1, we've got a indicator that was built for this system. Anthony Reno, our developer, he developed a indicator for this, which is great, and it throws them up on the screen. So it will throw them up historically, identify them before you've even tried to draw all that out, so it can make your trading very, very efficient as well. And all you do is you install this onto your NinjaTrader or your MT4, and away you go. It will show all of the entries and targets before the trade's even taken place. So today, for today's giveaway, we're actually going to give a copy of this to someone, which is cool. So we're going to pick a random winner later on, and you have to keep an eye out for your emails in order to see who won. I think we're going to do that, aren't we, Darren? Akil? Forgive me if I was supposed to announce a winner. No, we're going to do that. Yeah, excellent. Great. Great stuff. Charles will be sending out some stuff, or Darren will send out some stuff, and it will have the winner in there. But what I really want you to take out of this session, guys, is the fact that you have to have rules. You have to have a good system, a good strategy, right? And you have to have some sort of accountability. You have to maintain consistency. Secondly, you can earn money anyway in trading. But thirdly, it's up to you to expand the possibilities to put into a system to develop your unique edge. There's no such thing as an off-the-shelf strategy. And if I could just get that one point across to you, and that's the only thing you take out of this whole boot camp, I'm glad. Because I know you're not going to go out there furiously burning money, because you're going to always think, well, that's not quite the right thing to do. If I'm going to do this, I need to put some work into it. And I need some tools, and I need some community, and I need a decent strategy, and then I need to understand the ins and outs of that strategy, and then I'm going to go and get excited about testing it and tweaking it and adding filters. And that's really what I want you to get from this session. So I hope you've enjoyed that. We're going to tie it off about there. If you've got any questions, let us know. Obviously, we're going to go into detail in questions on Friday as well. So I just want to say thank you very much for joining us again, guys. We'll stick around for a few minutes. And yeah, I'll see you back here tomorrow, same time. So I'll see you then.